Welcome to the Time and Market Deep Dive.
Yeah.
I am really excited you are here with us today.
Absolutely. It's going to be a fun one.
It is.
Right.
But right off the bat, I need to give our standard disclaimer. Everything we are talking about today is purely for your entertainment. This deep dive is not personalized financial advice, so, please seek out a professional before you go moving your life savings around.
Yes, very important. Don't just trade based on a deep dive.
Exactly. Oh, and also drop down into the comments and let us know if there are any other topics or specific papers you'd like us to explore in the future. We love getting your suggestions.
We really do read them all.
We do. So let's get into the mission for today's deep dive. We are unpacking the absolute bedrock of what's known as factor investing. Because, when most investors look at the stock market, I think they just see this chaotic ocean.
Oh, completely. Just noise.
Right, just prices going up, prices going down. But beneath those choppy waves, there's actually an entire architecture of, invisible, mathematically measurable currents.
And mapping those underlying currents, that has basically been the holy grail of quantitative finance for, the last 40 years. We're talking about isolating the exact DNA of stock returns.
Which brings us to our stack of sources for today, and it's a really fascinating mix.
It's incredible.
Yeah.
We are tracking the evolution of these factor models. So we start with the foundational academic papers by Eugene Fama and Kenneth R. French.
The absolute legends, Nobel laureate level stuff.
Exactly. Their papers from 1993 and 2015. But then we look at the massive industry pushback from AQR Capital Management and their six-factor model.
Which is such a great drama.
It really is. And after that, we're diving into international data, looking at China and 26 different emerging markets.
Just to see if the math holds up globally.
Right. And finally, we're looking at a cutting-edge ArcSave paper that basically says, let's just hand all of this over to deep neural networks.
Which is where things get really sci-fi. But, okay, let's start at the beginning. Reading through that 1993 Fama and French paper, it is wild to remember what they were actually disrupting at the time.
Oh, yeah. The baseline back then was the capital asset pricing model.
CPM.
Right, CAPM. For decades, the entire financial world operated on that single-dimensional ruler. The basic assumption was that your asset's expected return was dictated purely by its market beta.
Right, its sensitivity to the overall market. So for the listener, let's ground this in reality. Say you have $100,000 to invest today. The CAPM approach is basically just buying a massive, broad index fund, like Vanguard's VOO or VTI, right? You just own the whole market.
Essentially, yes. If CAPM were entirely true, the only way to beat that generic VTI market return would be to just take on more systemic risk, lever up.
Right.
But it was an elegant theory that the data just didn't support in the wild. Fama and French started looking at the residuals, the returns that CAPM completely failed to explain. And they found these two massive anomalies hiding in plain sight.
The size effect and the value effect.
Correct. So the size effect, which they quantified as SMB, or small minus big, it showed that small cap stocks systematically outperformed large caps over long horizons.
And then the value effect, right? HML.
Yeah, high minus low. This proved that companies with high book-to-market ratios, meaning their accounting value was high compared to their actual stock price, those companies systematically crushed expensive growth stocks.
Okay, so let's go back to that 100 grand example. If you put $100,000 into a broad market fund like VT over, say, a 10 or 20-year horizon, it's going to do pretty well. But Fama and French are basically saying that if you systematically tilt that portfolio toward those small value companies,
you'd capture a proven risk premium. Historically, over a 20-year period, that tilted portfolio would significantly outpace the broad VT index. Your 100 grand would grow much larger.
Though it's not a perfectly smooth ride, right?
No, definitely not. It's a risk premium for a reason. You have to endure periods where small cap value underperforms. But over the long haul, the math is incredibly clear.
It makes me think of basketball scouting. Relying only on CAPM is kind of like judging a basketball player's skill entirely by their height.
That's a great analogy. Height matters, obviously.
Right, it matters a lot. But the three-factor model finally added crucial stats to the scouting report, like, speed, which is the size factor, and shooting percentage, the value factor. It finally gave investors a complete picture of the player.
And the jump in precision was just staggering. By adding size and value to the market risk factor, their three-factor model increased the explanatory power of stock returns from roughly 70% under CAPM to over 90%.
90%. That's almost the whole puzzle.
Exactly. Dimensional Fund Advisors actually published a great piece in our sources highlighting how revolutionary this was. It created a legitimate third option for institutional investors.
Because before that, you basically had to choose between blindly picking stocks or just passively accepting the market.
Right, you didn't have to pay massive fees for an active manager throwing darts, and you didn't have to just accept the VT market return. You could systematically target these premiums.
But, the part of the reading that really threw me was the 2015 update.
Ah, the five-factor model.
Yeah. I mean, you would assume a model explaining 90% of stock returns would be the final word. But 22 years later, Fama and French published this massive update, and they essentially canceled their own masterpiece.
It's actually a brilliant example of academic integrity. They recognized that the three-factor model still left some significant variations unexplained. So they went back to the fundamental physics of valuation, specifically the dividend discount model.
I want to pause on that because the mechanics here are super important. The dividend discount model essentially says a company's stock price today is just the current value of all its expected future dividends, discounted back to the present.
Exactly.
But how does that translate into two brand new stock market factors?
Well, if you look at that equation, holding the current stock price and the book value constant, there are really only two ways a company can generate higher expected future cash flows.
Go.
First, it can simply be more profitable today. Second, it can invest less of its earnings into expanding its assets, which leaves more free cash to return to the shareholders.
Ah, okay.
So Fama and French derived two new metrics: profitability, which they labeled RMW for robust minus weak, and investment, labeled CMA for conservative minus aggressive.
And the historical data they ran just absolutely backs that up, right?
Yeah.
Highly profitable firms out-earn less profitable ones, and conservative companies outperform the aggressive empire builder.
It backed it up beautifully. But here is the blockbuster result. When they plugged profitability and investment into the regression, their legendary value factor, the engine that made them famous in 1993, suddenly vanished.
It just became completely redundant.
Statistically redundant, yes. It wasn't just a slight drop in significance, it was absorbed entirely.
Wait, how can something be the holy grail of investing for 22 years and then suddenly be declared redundant just because you added two new columns to the spreadsheet?
To understand why, you have to look at what value actually represents. A high book-to-market ratio is essentially just a noisy proxy.
A proxy for what?
Well, if a company's stock price is depressed relative to its book value, the market is usually pricing in low future profitability, or it expects the company to burn cash on heavy capital expenditures.
Oh, I see. So once you have the specific mathematical tools to measure that profitability and capital expenditure directly, you just don't need the blurry proxy anymore.
That's the crux of it. The value premium was real all those years, but it was essentially a shadow cast by profitability and investment behavior. If you directly measure the object casting the shadow, looking at the shadow itself becomes completely redundant.
Wow. I mean, I understand the math, but the five-factor model still feels kind of incomplete. Even Fama and French admitted in the 2015 paper that this upgraded model has what they called a lethal blind spot.
Yes, the microcap extreme growth stocks.
Right. It completely breaks down when trying to explain that specific corner of the market.
It does. The model expects them to perform poorly, given they usually have weak profitability and aggressive investment profiles. But the reality is actually far worse.
They perform that badly.
Abysmally. These are tiny companies burning through immense amounts of cash, essentially buying lottery tickets for explosive growth. Their actual returns are so bad that they create a massive negative intercept in the regression.
So the five-factor model fundamentally fails to digest just how toxic that specific combination of traits really is.
Exactly. And that failure naturally opens the door for the rest of the industry to start poking holes.
I mean, you don't just tell Wall Street that the value factor is dead and expect the hardcore value investors to just nod politely.
No, definitely not. Which brings us to the AQR capital management research in our stack.
Right.
They absolutely refuse to accept the 2015 model.
They basically launched a full-scale rebellion with a six-factor model.
They did. And AQR's critique is highly methodical. Their first major objection is the glaring omission of momentum.
Momentum,
Yeah.
which they labeled UMD, up minus down. Right?
Yes. Momentum is the incredibly persistent, well-documented tendency of recent winning stocks to keep winning and recent losers to keep losing over a 6 to 12 month horizon.
But Fama and French obviously knew about momentum. It's not a secret.
Yeah.
Why would they leave such a powerful force out of their definitive asset pricing model?
They argued it was basically a matter of dimensionality. Momentum is highly dynamic and largely independent of the other fundamental factors. Fama and French felt that if they were just trying to explain the cross-section of standard equity portfolios, they didn't need it.
But AQR's counter-argument is deeply practical. They're saying, if you are a real-world investor building an actual portfolio, ignoring momentum is basically malpractice.
Exactly. AQR insists that if your goal is actual performance attribution, leaving out the strongest performing factor is totally absurd. You can't brush it aside just to keep your academic regression looking tidy.
Right. But they didn't even stop at momentum. AQR went directly after the mechanics of how Fama and French measured the value factor in the first place.
This is where it gets really technical, but it's so important.
It's my favorite part of the AQR paper, honestly.
Yeah.
It highlights how a seemingly tiny data crook can completely alter our entire understanding of finance.
Right. Because Fama and French built their value factor, HML, using heavily labbed data.
Heavily lagged, like 18 months old in some cases?
Yeah, they used book-to-market data where the stock price was lagged by anywhere from 6 to 18 months. And to be fair, they did this to strictly avoid look-ahead bias.
Okay, explain that for a second. Look ahead bias.
Sure. They needed to ensure they were only testing accounting data that was definitively public and available to a hypothetical investor at that exact historical moment. So they matched the old confirmed book value with the old stock price from that exact same date.
I mean, I get the academic intention, but using an 18-month-old stock price to determine if a company is a good value today makes absolutely no sense.
It really doesn't, practically speaking.
It's like printing out a MapQuest route at the start of a cross-country road trip and then refusing to look at the GPS on your phone when there's a massive detour right in front of you. You are intentionally throwing away perfectly good, timely information. The market tells us what the stock price is every single second.
AQR saw that exact same flaw. So they engineered a new metric called HMLDEV, the DEV cheekily standing for the devil in HML's details.
I love that.
It's clever. So they maintained the rigorous standard of using the safe, lagged accounting book data so they wouldn't violate look-ahead bias. But they divided that old book value by the most recent monthly stock price.
Which changes everything.
It does. Think about the logic here. If a company's core business remains steady, but its stock price plummets by 40% over 6 months due to some market panic, it has objectively become a better value.
Right. But Fama and French's lag model wouldn't recognize that value for another year.
Exactly. AQR captures it instantly.
So what actually happens when AQR runs the historical regressions with this real-time GPS version of value alongside the new momentum factor?
AQR calls it the resurrection. When you run the six-factor model using timely value and momentum, value comes roaring back to life. It generates a massive, statistically robust intercept. It is not absorbed by profitability or investment anymore.
Wow. So value isn't just a noisy proxy. The original measurement was just using outdated noise.
Precisely the point AQR made, but here is the profound irony of the six-factor debate. Once AQR introduces timely value and momentum into the mix, a completely different factor gets pushed out of the boat.
Wait, really? Which one?
Fama and French's prized investment factor, CMA, suddenly becomes almost entirely redundant.
Seriously, how does investment become redundant just because we updated the stock price and the value calculation and added momentum? What is the mathematical overlap there?
Well, it comes down to what a conservative investing company actually looks like in the real world. Firms that invest conservatively at the CMPMA, they tend to be mature, stable companies. They often have depressed prices, but solid fundamentals, making them strong value stocks. And because they aren't blowing cash on aggressive expansion, they often exhibit positive, steady momentum.
Oh, I see.
Conversely, companies aggressively expanding assets are usually high-priced growth stocks with volatile or negative momentum. So AQR demonstrated that the investment factor was essentially just a blended proxy for timely value and momentum all along.
That is a seriously high-stakes academic showdown. Depending on whose price data you use, you either kill value or you kill investment.
It's a fundamental disagreement on market mechanics.
But, reading through these papers, I noticed a huge geographical bias. All of this intense debate from the 1993 three-factor to AQR's six-factor, it's built almost entirely on the United States stock market.
That's true.
If these are fundamental laws of financial physics, shouldn't they apply in Shanghai or Sao Paulo just as well as they do in New York?
That is the ultimate stress test for any economic theory. Are we measuring human behavioral truths or just a 50-year quirk of American capitalism?
Right. So what does the international data tell us?
It's incredibly revealing. Let's pull up the study on the Chinese stock market. In China, the five-factor model actually holds up reasonably well against the three-factor model. Interestingly, the Chinese market exhibits a very stable dominant size effect.
Really?
Yeah, the small cap premium is deeply entrenched there, far more reliably than it has been in the US over the last decade.
Okay, so China looks somewhat familiar, maybe a bit more tilted to small caps. But what happens when we zoom out to that massive study covering 26 emerging markets from 1992 to 2021?
The script completely flips. It's a totally different economic ecosystem. In those 26 emerging markets, the researchers found that size and investment are actually the redundant factors.
Wait, size and investment. Neither one works.
Neither one provides unique explanatory power. Instead, value and profitability are the undisputed primary drivers of asset returns across the developing world.
So the factors that dominate the market actually change based on the structural maturity of the economy you're trading in.
Exactly. And to Fama and French's credit, they ran their own international tests in 2017 and found something very similar. In Europe and Japan, the size and investment factors were also largely redundant.
So the U.S. market structure, with its unique blend of aggressive tech expansion and massive liquidity, is kind of an outlier.
It is an outlier, not the default global blueprint.
That's fascinating.
Yeah.
But, okay, we've spent this whole time tracking how human economists evolved these models. We went from one factor to three to five to six, constantly debating which human-defined category is the most mathematically pure.
Right.
But we are living in the 2020s now. We have to look at the Archive paper in our sources. What happens to factor investing when you take the humans completely out of the equation and just let deep learning neural networks map the market?
This is where the landscape fundamentally fractures from everything we've discussed so far. Traditionally, humans use linear sorting.
Like putting things in buckets.
Exactly. A researcher says, let's put the top 30% of book-to-market stocks in this bucket and the bottom 30% in that bucket. Even with six factors, it's a rigid, multi-dimensional grid. Humans are fundamentally limited by what we call the curse of dimensionality.
I mean, we can't even visualize a seven-dimensional grid, let alone sort stocks into it perfectly.
Oh, we really can't. But the deep neural networks in this ArcSIF paper don't use rigid buckets. The architecture utilizes what they call an augmented deep factor model.
Okay, how did that work?
The researchers feed the raw firm characteristics, so the raw data for size, book to market, profitability, past returns directly into the AI. The network then creates its own long-short factors as hidden neurons.
I need to understand those hidden neurons because it sounds like science fiction. How does a hidden neuron actually function in a financial model?
Think of a hidden neuron as a dynamic, deeply complex mathematical weight. Instead of a human saying, value is always good, the hidden neuron searches decades of data for interactive, nonlinear effects.
What does a nonlinear effect look like in this context?
It might discover a pattern where the value factor is incredibly predictive of returns, but only if that specific company's profitability is above the 60th percentile, its momentum over the last 3 months is positive, and it falls within a very narrow band of market capitalization.
Oh, wow. So it finds the exact mathematical thresholds where these characteristics amplify each other rather than just treating them as isolated, independent silos.
Precisely. The AI continuously adjusts the weights of these hidden, multi-layered connections to minimize the aggregate pricing errors across the entire market. It maps relationships that a standard linear regression simply cannot physically capture.
And looking at the out-of-sample results from the paper, the performance is honestly terrifyingly good.
It blows traditional CAPM and the Fama French models completely out of the water. In their tests, these augmented deep factor models generated Sharpe ratios, which measure risk-adjusted returns between 4.57 and 6.49.
Which is insane. To put that in context for anyone who doesn't stare at Sharpe ratios all day, a Sharpe ratio of 1.0 is generally considered good. A 2.0 is fantastic. A 3.0 is basically unicorn territory.
Right.
So hitting above 4.5, let alone 6.49, is almost unheard of in traditional linear modeling.
It represents an almost unbelievable level of return for the amount of volatility taken on. The AI is capturing a much, much purer signal from the noise.
Which really brings us to a massive existential crossroads for finance. If deep learning can optimize these factors so perfectly by finding complex, hidden, nonlinear relationships, does that mean the era of human economists debating value versus profitability on a whiteboard is officially over?
It certainly challenges the utility of human-designed models. I mean, if an algorithm can isolate the precise DNA of stock returns by mapping 40-dimensional relationships, sticking to a human-readable five-factor spreadsheet starts to look like, insisting on using an abacus because you don't trust a calculator.
That is a stark way to put it, but it makes total sense. So let's synthesize this whole journey for the listener. We started with a flat Earth view of CAPM, where market beta was the only thing that mattered.
And passive indexing like VTI was the only logical play.
Right. Then Fama and French proved that if you want to truly understand returns, you have to look beneath the index at the fundamental characteristics of the companies. Then AQR proved that real-time data and market momentum are just as vital as the accounting fundamentals.
Yeah. And whether you subscribe to the original three-factor model, the 2015 update, AQR's momentum-fueled approach, or even the global variations, the core truth of factor investing remains intact.
Which is?
That portfolios don't just win by luck. They win because they are systematically exposed to specific underlying risks, size, value, profitability, investment behavior, and momentum.
It gives you the actual physics required to navigate that chaotic ocean we talked about at the top of the show.
It really does.
But, I want to leave you, the listener, with a final lingering thought to mull over. We just saw that deep learning AI can generate off-the-charts 6.0 sharp ratios by spotting nonlinear patterns that humans literally cannot visualize.
Yeah.
If a neural network builds you the ultimate unbeatable portfolio, but its hidden neurons are so mathematically dense that no human alive can explain why it's making those trades, would you trust it with your life savings? Is understanding the why actually necessary, or in the financial markets? Is profit the only truth that matters?
That is a profound and honestly slightly terrifying question to end on.
It really is.
Yeah.
Well, thank you so much for joining us on this deep dive. Keep questioning the models, stay insanely curious, and we'll catch you next time.